Hello viewers, in today's video let's assess one critical approach in investing, and this is dollar cost average in particularly bad markets. Because, well, if we are investing, what's one of the largest fears, so to speak? The fear is that we might be investing prudently, patiently and consistently for over the term when markets are falling, and this is like the absolutely worst thing to do. One worst thing to do is to invest like bulk sum of money in absolute peak, and second worst thing you could do is to invest consistently when markets are falling. It might be quite dreary because you could see that your money on the paper is slowly eroding. But how does actually it stacks up? Well, here's the thing. Not that long ago I stumbled at one rather interesting research material which effectively assessed how your investment might look when you could invest in absolutely worst market conditions that you could have. That's Japan since 1990. And this is not research for me, but for one interesting researcher which has labeled himself a Fergler doctor. I don't know him, but he had really good assessment of dollar cost averaging. So let's get into that and see. Now he has been going to Nikkei index. Yes, here's the thing. Here is what Nikkei index looked from late 1989 since late 29. So if you look that, this probably is like the nightmare of an investor. You are doing everything right. You are following index funds rather to find specific investing strategies because you know by fact that's better on the long term. You are doing dollar cost average because you are avoiding market timing. But this is what happens, like the very worst market that you might imagine for goddamn 30 years, 32 years, you know. What could be worse, you know? This generation of savings simply destroyed. And here's the thing. No one could objectively know if something like this might not happen with European or American markets, because in the 80s Japan was industrial giant, it was economic giant, and stock market and real estate market in Japan reflected that, because they had leading companies, they had the richest men in the world, they had even innovations, exports, technology, everything. So if someone would say that Japan for next 30 years will have falling market, no one would believe that. So don't take for granted that any stock market in any country could give you something for granted. And the fact that Dow Jones has returned certain percentages over 150 years or something like that doesn't mean the next 10 years would be like that. Please bear that into mind. This is extremely important to understand. But anyways, this is something like nightmare in chart. This is like the worst thing what might happen to investor in one chart. It's here. So he also talks about these instances. How likely is it happening to the United States? And in fact, no one knows that. But here's the thing. Here is how the returns would look with dividends invested. So we have a bit nicer picture here. Now it looks like something because compounded interest starts to work. Because even those stock market returns might be a symbol or catastrophic, but they still make money and they still pay dividends. And if you reinvest those dividends, they give you some sort of passive income. Of course, it takes time to do that, but overall, what here most likely this chart shows you is not this is great investment, but compounded interest starts to work over the time, even if the situation is catastrophically bad. So that's the one thing. And here is how does it look if you are making monthly investments. After 30 years, amount of invested is 300,000, but overall portfolio value is 606,000. You see, that's what happens when you invest $833 per each month. over the time. Why? Well, because if you look at these returns are not negative, they are overall negative, but those bad, when we have where we have this chart, they are not all bad. You could see, if you could split that between months, you would see that it's not actually that bad since 1992, because it actually has risen, and since 2011 there has been quite a decent returns. It has been more than tripled in its returns. No, almost tripled. Yes, excuse me. Made 3.5 times its money, so from 8,400 to 28,000. It looks depressive on long term, but if we stack these returns by monthly basis, it looks a little less depressive. So, as I'm always saying, charts could fool your eye because you see what you want to see. But here's the thing: if we look at those monthly returns and compound them by investing each month constant sum, we could make something out of catastrophic situation. And you could, yes, you have to spend 14 years, because monthly overtakes lump sum only by July 2003, but still it is catastrophically bad market, and this is like the worst examples of worst examples, and you could see how these compounded returns made their way. What I could give you with this chart here is that what I'm always saying, it's the approach that makes you money first and foremost, and then only are percentages of returns. But of course these also are important. Here we could saw that markets were falling like a cliff in the late 80s to early 90s, then were staying flat and made slight downward trend to like 2011, and then they grew. And then that reflected both in stock market when we invested like a lump sum in 1989, and it only made money in after 30 years. But if we invested and take into consideration these monthly returns each month by smaller sums, compounded interest really took off and made its bet. And here's the thing: if we would look at regular markets, they could make much decent returns comparing to these catastrophic returns we have now. And that's what I'm always saying you. Even if these catastrophic markets would make you some money, how that would stack if the returns would be much decent? Well, answer you could say to yourself, but my point here is that we took the worst markets possible and made money out of them, because we had proper strategy and long-term plan in place, and we reinvested all our capital and had cumulative returns in our favor. And that's the idea of long-term strategies. So we will see these kinds of videos later on, so make sure you are following me. Bye.